When the rest of the markets slow down, the futures market keeps moving. Did you know that CME Group S&P 500 and NASDAQ 100 futures trade nearly 24 hours with great liquidity? In the ETF markets, volume and liquidity lessens after 4 p.m. until the next morning. But with futures, you get trading opportunities both day and night. Learn more at cmegroup.com/equity-futures.
These days, AI can help you adopt better time management, but it can't stop colleagues booking meetings during lunch. But how about being able to easily adopt industrial AI to streamline your business? Siemens Accelerator helps you find the right AI providers and easily understand what they offer, so you can use modular solutions to quickly scale up and grow your business. That's AI for real, from the global market leader in industrial AI, Siemens. Learn more on usa.siemens.com/AI.
Running small and medium-sized businesses is hard work. Business owners need to be sure their ads are working just as hard as they do. Amazon streaming TV ads makes your marketing dollar work harder. With Amazon ads, trillions of insights help small and medium businesses reach the right customers that matter. Your ads will show up during the shows the people are actually watching, and measurement tools show you what's working the hardest. Gain the edge with Amazon ads.
Bloomberg Audio Studios. Podcasts, radio, news.
It does look like the Fed will cut
25 basis points.
A 25 basis point cut.
If they do 25 bips or if they do even 50, the market should be able to take it.
The Fed will still probably be looking for 2 cuts this year.
3 cuts this year and more to come next year.
Somewhere between 5 and 6 25 basis point cuts out to 2026.
If you continue to see this kind of momentum on the labor market, to get several more cuts in the back half of the year.
There are signs that you'll continue to see that weakness in the labor market data.
If you look at the trend, it's weakening.
In the balance, the Federal Reserve will look at the labor market for now, but they have to keep one eye on inflation.
Chair Powell better sound relatively dovish.
He's going to provide very limited guidance.
The decision 15 minutes away. The consensus view, a move of 25 basis points. 2 outliers. SocGen, Standard Chartered, looking for 50 in about 15 minutes' time. The scores into it look like this on the S&P 500, not far off all-time highs. We're down 1/10% this afternoon. In the bond market, 2s, 10s and 30s shaping up as follows. Your bond yield curve looks like this. Yields higher by 4 basis points to the front end, 354. We have rallied a lot at both the front and the long end over the past 6 weeks.
Yeah, and we've seen even a rally in credit. Just to give you a sense of just how much 10-year yields have rallied. They are down from 4.37% as of July 30th, the last Fed meeting. They are now at 4.03%. Just giving you a sense of that momentum.
A couple days ago, we popped 3.99 in the 10-year, and this morning we made a dash toward just for a cup of Sanka. But the answer is yield space is moving. Greg Peters is exhausted.
Go further out. Go to 30s. Only a few weeks back, we're at about 5.
Yeah.
Come all the way back down towards 4.5%. And the way the curve has evolved through August into September. August, we had a bull steepener, big rally at the front end. September, it's been completely the opposite. We've had a bull flattener, led by the long end.
And the reason for it has been different depending on the person you've spoken to. Some people say it's because of the threat of yield curve control or some sort of machinations in the balance sheet. Other people saying, look, if you have all these people in cash, you cut rates, well, they want to lock in that yield, so they're going to go out the curve. That's a new argument, and we're hearing it more.
Joining us now to discuss, Kathy Jones of Charles Schwab, Greg Peters of PGIM Fixed Income, still with us. Kathy, let's start with expectations. What are you expecting in about 13 minutes' time?
Yeah, we're looking for 25, which is the consensus. I guess there's an off chance it'll be 50, but given that inflation is still pretty high, I think it's going to be difficult to have a really aggressive rate cut at this stage of the game, even though the labor market's showing signs of deterioration. An unemployment rate in the low 4s is still not that far from what's considered full employment. And then you've got inflation at 3-ish and edging higher. I think it's very difficult to make the case for 50 in this environment unless you have a really negative view of where the labor market's going.
Given that backdrop, Kathy, why do you think there's been such a rally in the long end of the yield curve since the last Fed meeting?
Well, we've had the rally because the expectation, we've had weak economic data and we have a greater expectation for rate cuts. And so, the market has a lot of rate cuts built into it out to 27. So the long end's been pulled down by that. But I would point out that the curve is still steep and steepening. We're still looking at a steeper curve as we go forward, even if it's somewhat lower rates. I don't know that the long end can kind of get out of its way if we still have inflation pushing higher, and the dynamics behind inflation are still not great.
Kathy, what's your action plan to put cash to work? I understand we're before the meeting. Let's go after the meeting, but let's take it out into next year as well. What's the Kathy Jones action plan given Fed chaos?
Well, we're hoping people aren't too heavily in cash at this stage of the game, because we've been encouraging them to be intermediate term on the curve and up in credit quality. And I think that is still our plan. We'll see how Fed policy evolves. We'll see how the economy evolves. But we're really looking for a fair amount of volatility going forward. There's a lot of things on the horizon policy-wise that can shake up the market. So we don't want to go super long, but we don't want to sit in cash, because I think the bias is still to cut rates.
Greg Peters, let's get to you on some of this. Why are so many people so comfortable just sitting and waiting in the belly of the curve?
Because they're positive carry, right? You positive carry and roll. It's the bond investor's dream. And so you look at just the level of yields, the steepness of the curve. It's it's a very good environment for just being in bonds, and I would say that's a global story, just not a U.S. story. So I don't think the bond quote unquote bull market goes away. I think it's a very robust environment for bonds. One point I want to just make, though, just on volatility.
Sure.
What's really important to watch is the trend in volatility. Typically, what you see as the Fed enters the easing cycle, volatility broadly comes down. It pulls volatility down. So if you actually see vol actually move higher in this rate easing cycle, that could be a sign that there's concerns around, Fed independence, risk around the economy, all these other types of things. So it's something to watch for. It sounds like an arcane part of the market, but it's a really important one to get a view into.
Greg, how crowded is the long bond right now? The shorts were pretty crowded, and they got stopped out, and that was probably a significant part of it. At this point, how balanced is positioning?
Yeah, so positioning is much more balanced. So you're quite right. The move was around positioning, right? I think at the end of the day, we're fitting a narrative to the positioning trade more than anything else. But the positioning side is much cleaner. As a consequence, I think there's room again for the curve to kind of gently re-steepen here. But positioning has played a part. It will continue to play a part. And so this is, how we invest these days.
Kathy Jones, are you writing a strategy as a Fed cut? Is it one-off, or is a series of rate cuts on the edge of Greenspan? What strategy are you writing right now?
Yeah, we do think there'll be a series of rate cuts, but we're not expecting the cycle, so much as we can tell at this moment in time, to be as deep as the market has priced in. So, and that's because our view on inflation is that it's going to remain stubborn because of tariffs, because of immigration policy, you name it, there are a number of reasons. And so we're looking at a series of rate cuts, but not as deep as what the market has priced in. Another reason we're being kind of cautious and anticipating volatility is because we think the market's gotten pretty far ahead of where the Fed is likely to go. And then you add in all the uncertainty about who's running policy at the Fed and the future, and it becomes a stew pot of factors that could cause vol to pick up.
And this is something Brian Moynihan was essentially alluding to earlier on this morning, that in 2026 you could have a sticky inflation story that may constrain that easing bias of the Federal Reserve.
Yeah, speaking not only to Brian Moynihan, but all of the people under him and the acceleration you're seeing in consumer spending, and then speaking to Scott Kirby over at United and hearing the same thing, this reacceleration in consumer spending, it doesn't scream some sort of slowdown or recessionary condition.
They're talking about resilience. We're talking about an equity market near all-time highs. investment-grade credit spreads near multi-decade tights, and yet we're having a conversation about whether this Fed, in 7 minutes' time, will cut interest rates by 25 basis points or 50. Subhadra Rajapra of SocGen is with us now for more. Subhadra, I want to get to you on that. The 50 basis point view, is that what you and the team are looking for, and ultimately why?
So I think the spirit of the call from our economists is the fact that given the information we have on the job market and the revisions, quite dramatic, the Fed has some catching up to do. So the idea is that the Fed is going to have to front load some of these cuts between now and the end of the year. So whether it's a 50 basis point cut at the September meeting and then another 25 basis point cut, or a series of 25 basis point cuts, these cuts coming earlier and sooner makes a lot more sense, given the fact that we now know that there's a decent amount of weakness in the labor market. That said, I am sympathetic to the market pricing of cuts, which is calling for, 3 cuts, but kind of more spread out as opposed to 50 basis points at the September meeting. The data, especially recent data, the retail sales data has been very strong. And outside of the labor market, most of the other data points that we've gotten, ISMs, et cetera, have also been somewhat surprising to the upside. So given the fact that, the economy is in a relatively good spot, the Fed does have a little bit of luxury in spreading out those cuts.
Subhadra, you're talking about the evening special on Sunday on C-SPAN. We want to talk about the B-movie, at least as Greg Peters was talking about earlier, the sort of drama in the background. In other words, to put it bluntly, how much does it really matter to you as a bond strategist what Stephen Myron says, given that he is a new governor and he has the full backing of the president?
It does matter. I think words do matter. I think the fact that if you at least optically, when you have maybe 3 governors dissenting for the first time since the late 80s, I think that that's really going to stand out. And what would be interesting is if you actually have dissents on the hawkish side. And that'll really make the meeting very colorful. I mean, if I could, I'd love to be a fly in the wall in these discussions over the last couple of days. But again, I think that these statements and sentiments do carry value. I think broadly speaking, I think that's what the market's trying to suss out as well. Because if you look into the end of next year, you're looking at pretty decent amount of cuts being priced in. So the market is assigning a higher probability for a much more dovish, Fed committee, FOMC committee next year.
So, Badra, Societe Generale is a Paris bank in a nation in a complete, total uproar. We all know the French story, the politics and all. This Fed meeting is invaded by politics. Does Jerome Powell have to speak to the non-financial America out there?
Yeah, he always does. I think that the messaging has always been very clear and simple. They do look at policy for all Americans, all sectors of the economy. They are going to take into account that there are certain sectors of the economy that are particularly coming under, pressure, especially if you look at, the employment side of the picture. We still have haves and have-nots economy. So Powell, I think, is going to be very, very focused on trying to keep basically all constituents of the economy in mind while changing policy. And that's part of the reason why I think it makes sense for them to front-load cuts, this year.
Kathy, 4 minutes, less than 4 minutes until we get that decision. If you were in the press conference, what would your one question be to Fed Chair Jay Powell, if you had one?
Well, I'm going to assume that whoever went before me asked about squaring up the dual mandate with the rate cut. And I would go on to ask a bit more about the concept of maturity matching on the balance sheet. This is something Governor Waller has talked about, and I think Stephen Myron might embrace as well. And I think that has some implications longer term for how the Fed proceeds and how the market develops. So I would definitely ask that question if I had the chance.
Balance sheet management, Bramo, keeps coming up, doesn't it? Yield curve control,
right?
All of these things, these questions keep coming up.
Yield curve control under another name. I mean, people start tuning out and they hear, tweaking the balance sheet and maturity matching. That is another way of backdoor yield curve control that a lot of people are trying to understand.
Kathy Jones of Charles Schwab, Subhadra Rajapra of SocGen, to the both of you, thank you. That decision is about 2 minutes and 30 seconds away. We've talked about this 3-part act. We got a statement, the forecast, the news conference. Let's just sit on the forecast. The Federal Reserve has to project and forecast not payrolls, but unemployment. And going into this, I wonder if we're going to be surprised more by how much the SEP changes or by how much the SEP actually remains the same. How much can these forecasts around things like unemployment, for inflation, actually change? And that's what's interesting about the moment. Typically, when the Fed is projecting more interest rate cuts, you'd expect a big downgrade to growth. You'd also expect an upgrade to unemployment. We might not get that in 2 minutes' time.
Especially given the fact that we're at a pretty neutral pace. Just taking a look at where we were, the projection was for 4.5% at the end of this year in terms of an unemployment rate and a 3.1% core PCE. It wasn't expected to shift that much on either front over the following couple of years.
John, I think what you bring up is a really, really important point. What confidence do we have in our guesses out to June of next year, December? Liz Ann Saunders had the map of the day. It was household insurance across America. Let me tell you, half of America's flat on their back with fixed costs surging.
This is the question, I think, for the committee today and for the news conference, too, for Chairman Powell. And there was a key difference between how he addressed this question in July and how he's thinking about it over at Jackson Hole in August. What is anchoring your view on the labour market right now? Is it the unemployment rate? Is it measures of slack? Or is it payrolls growth? Because the Chairman Powell of July was very different to the Chairman Powell of August,
who said that it was really important back in July to look at the unemployment rate and then the payrolls headline figure. The problem is right now, people really dispute the idea that we have the same kind of labor market that requires the 150, 200,000 jobs created per month, and that this is more of a 50,000 a month kind of break-even rate that we should be looking at.
Do you get lulled into a bigger conversation, a bigger decision than you otherwise would have made? And that's something that this Federal Reserve has to confront today and for the next several months. That decision is 20 seconds away. The question is not if they'll cut interest rates. The question is by how much, 25 or 50, and how much can you project in the guidance, the forecast? Equities going into it just about unchanged on the S&P 500. In the bond market, 2s, 10s, 30s look like this. Your 2-year bond yield up by 3 basis points with your Fed decision. Here is Mike McKee.
The answer to your question, John, is a 0.25 percentage point cut as expected. But Fed officials also see 2 more cuts this year in October and December, according to the new dot plot. There was one dissent, and that is from Stephen Myron, the Trump representative on the board, who wanted no cuts this time. He wanted, rather, 2 cuts this time, 50 basis points. Next year, the committee sees only 1 cut so far, but the dispersion is very wide. And the very bottom dot for next year is at 2.75%, suggesting, once again, that is Stephen Myron. The committee sees that the risks to that they are attentive to the risks of both sides of their mandate, but they say the risks to the downside for unemployment have increased, and that's the reason that they are cutting rates today. They also adjust the forward guidance in the statement to drop the word extent and just say in considering additional changes to the target range in the future, they will consider all kinds of options. There is no real change to their economic forecasts, but we don't know exactly why that is, whether it's because Myron contributed different numbers than others, or Anna Paulson, the new Philadelphia Fed president, contributed different numbers than others. But the growth rate is marked up for this year to 1.6% from 1.4%, and the unemployment rate is unchanged at 4.5%. PCE inflation at 3% is unchanged from their July forecast, and core PCE inflation unchanged at 3.1%. There's no change overall to the balance sheet. And once again, there was one dissent, Stephen Myron, the new member of the board from the Trump administration. The rest of the board, including Mickey Bowman and Chris Waller, satisfied with moving the rate down to the range of 4 to 4.25%.
Mike McKee, thank you, sir. Stay close. We'll take some time to internalise what we've just heard from the Federal Reserve. A lot of information. Equities off the back of it, still just about positive by 0.1%. In the bond market, yields just a little bit lower at the front end of the curve, down by 2 basis points on 2s to 3.48. And foreign exchange, some euro strength, some dollar weakness. We approach 119 on euro dollar, which is its own story, which we'll get to later, 118.84. I want to do a couple of things. Let's take the forecast and just focus on 2025 and 2026. And I just want to focus on where the projections were in June and where they are now. And just go through this piece by piece. For GDP, compared to June, that's an upgrade for this year and for next year. For the median dot, we've gone from 3.9 in June down to 3.6 for now. So we're looking for another 2 cuts. For next year, we've come down from 3.6 to 3.4. And PCE has remained pretty stable, I've got to say, for this year. For next year, they're looking at around 2.6%, up from 2.4. So just get into this a little bit more. What an odd decision we've got here, Bramo. That this Federal Reserve, and you don't usually see this, has cut interest rates by 25 basis points, has increased by just 1 interest rate cut relative to where we were in June for this year. At the same time, they've upgraded growth, kept unemployment basically unchanged, and basically projecting CPI to be sticky and close to 3%.
And saying in their statement that inflation has moved up and remains somewhat elevated, as their SEP, their Statement of Economic Projections, suggests. So then why is the bond market rallying? Why are yields down, even at the long end, if this is basically the projection that inflation will remain high and they will cut into that inflation? And what this hints at, and this I think is really going to be interesting, is this clear desire by the Federal Reserve to overweight the economy, even allowing inflation to run hot, and they will keep cutting despite that inflation. That is what is getting translated into this market.
I want to cross back over to Mike McKee if he's still with us and hasn't run off to the news conference just yet. Is Mike there? Good. Mike, I want to come back to you. How original is to see this, to see a rate cut, to see the projection of more to come, at the same time all these other things are happening with the forecast? How can you explain that?
Well, I think there's 2 possibilities, and they both center around the new members on the board, Anna Paulson from the Philadelphia Fed, and most probably Stephen Myron. When you look at the range of the forecasts for GDP, they moved up the bottom range and the top range, and the same is true with the unemployment rate. It didn't move at all, but inflation didn't move. And it seems that Myron probably put in stronger growth, lower unemployment, and at least unchanged or lower inflation going forward. And that probably accounts for the changes in the forecast. What's really interesting is the wide dispersion in 2026 dots. There's clearly no consensus yet on how many rate cuts they're going to want to see, except Mr. Myron thinks rates will go down to the 2.5% to 2% range.
Mike, I know you've got to run, but when you go into that news conference, you're starting to think about questions already. What do you want to know from Chairman Powell?
Well, I think you guys were phrasing it well there in your reaction. If inflation isn't going down, then why are you cutting rates is sort of a basic fundamental question here.
Mike McKee with the latest. You get ahead to that news conference. It starts in about 25 minutes' time. So we got 25.
When the rest of the markets slow down, the futures market keeps moving. Did you know that CME Group S&P 500 and NASDAQ 100 futures trade nearly 24 hours with great liquidity? In the ETF markets, volume and liquidity lessens after 4 p.m. until the next morning. But with futures, you get trading opportunities both day and night. Learn more at cmegroup.com/equity-futures.
How many vendors does it take to meet all your organization's food needs? Just one. EasyCater, the workplace food platform that lets teams order from a huge variety of restaurants, over 100,000 nationwide, all through a single vendor. In addition to all that variety, EasyCater also gives you full visibility of your organization's food spend with invoicing, centralized reporting, and seamless integration with expense management systems, all on one platform. EasyCater, your business tool for food. To learn more, visit easycater.com/podcast.
Introducing the all-new Adobe Acrobat Studio, now with AI-powered PDF spaces. Do more with PDFs than you ever thought possible. Need AI to turn 100 pages of market research into 5 insights with a click? Do that with Acrobat. Need templates for a sales proposal that'll close that deal? Do that with Acrobat. Need an AI specialist to tailor the tone of your market report to sound real smart in real time? Do that with the all-new Adobe Acrobat Studio. Learn more at adobe.com/do-that with Acrobat.
The Federal Reserve ultimately met the market for 2025. 2026 is a little bit more interesting because this market, Bramo, as you know, is much more aggressive on rate cuts for next year than this Federal Reserve based on the median dot in the Federal Reserve's projection. Because as Mike McKee just indicated, the dispersion, which is something you talked about, the spread of the dots for next year is incredibly wide.
And it makes one wonder if a certain dot has a greater weight than other dots, given the fact that the market is moving on the idea of more cuts, even though some of the other dots suggested only 2 cuts this year and relatively few next year. And the Statement of Economic Projections talks about a Fed funds rate that ends next year well above 3%. We are now below that in the futures market.
Something you're interesting, you got a median, you got a central tendency, you got a home in the range and all that. Guess what? There's not a median statistic here above 2%. Is sub 2% economic growth politically acceptable coming up on an election in 2026? I don't think so.
The answer to that is no.
No,
which is why
this
the
is the edge of Europe, is what I'm looking at.
To your point, TK, which is why this administration would like this Federal Reserve to be a lot more aggressive than these dots would imply.
Which is the reason why the market is hearing exactly what you're pointing out, that is not an acceptable kind of reality. And that's why I think it'll be very interesting to see how Fed Chair Powell really gets behind this.
Greg Peters, you're following the story as it evolves. What's your initial takeaway?
Yeah, so the initial takeaway is definitely prioritizing growth. Not surprised that Myron was far afield. I am surprised by only one dissent, though. But I think most people thought, myself included, you'd have 3. But I think the question that we're not asking is inflation itself. So is embedded in that forecast, is it still I'm sorry to say, transitory inflation component driven by tariffs that roll off over time? And so if indeed that is factoring in to the Fed, forward thinking, then that does mean there's more room for cuts because they're not as worried about that inflation component. So I would just be hesitant to look at the inflation number in abstract. I think what's driving it underneath is the key.
To your point, there is a very clean, dare I say, convenient glide path back down to 2% in the forecast from 3.1 to this year, 2.6 for next, 2.1 after that, down to 2 for core PCE.
Yeah, there's a big rebuttal on that, and that is in the dollar. And you mentioned this earlier. And the idea that long-term bonds yields are falling, you're seeing a rally across the board in everything but the dollar, which just hit the lowest levels going back for the entirety of this year. That is speaking volumes about exactly what you just pointed to.
We just took out 119 on euro dollar. Let's head over to Europe and catch up with Bob Michael at JP Morgan in the heart of foreign exchange in the city of London. Bob, great to get your thoughts. You've had about 8 minutes to go over this one. What jumps out to you, sir?
Couple things jump out. Greg's right. One dissent was surprising. We certainly thought there would be 3 pushing for 50 basis point rate cuts and possibly 2 suggesting nothing. And then also the fact that 2 rate cuts were pulled forward into this year. We thought there would just be 1 more for this year. So more or less where we were last time. It tells me that this is a Fed that locked arms, felt this was time to reduce policy from what was surprisingly restrictive to them. They were probably shaken by the labor market revisions and thought, wow, we've kept policy a lot more restrictive than we thought. Let's start getting to neutral and let's do it in unified fashion. I think this is good for the markets.
Bob, good for the markets. Let's talk about which ones. It might be good for risk assets. How much can this keep being supportive for long-term bonds, given that theoretically higher inflation would come on the heels of a prioritization of growth, and typically higher inflation is bad for long-term bonds?
Well, I wonder if the indication of higher inflation is just a suggestion to us not to expect 50 basis point rate cuts in here, but 25 perhaps every meeting for the next few meetings. Maybe they don't get down to 3% right away. They pause somewhere around 3.5 either side of that. I get that. I'm sort of with the Fed. We don't really know the shape of inflation until we see the final shape of tariffs. Right now, the evidence is pretty good. Businesses have absorbed some of it, and the consumer hasn't really pushed back all that much. And there's been signs of disinflation. So I'm not that concerned about inflation.
Bob, your colleague Michael Ferroli made global headlines a long time ago talking about a sub 2% potential GDP. Without COVID, tri-stimulus, and all the rest and the legislation, these median growth estimates today, do we have to get used to this? Sub 2% real GDP?
It doesn't feel like we're going to have to get used to it. It feels like we live in a world where policy will be generous on the accommodative side, both fiscal and monetary. We're looking at dots now, but we also haven't weighed in. Forget about tariffs. The One Big Beautiful Bill Act, that starts to hit in earnest in the first quarter. So I wouldn't be surprised to see GDP estimates go up next year.
For those of you just tuning in, about 10 minutes ago, 11 minutes ago, the Federal Reserve made the decision to cut interest rates by 25 basis points. There was one dissent, an individual looking for a 50 basis point cut. That was the newly minted Governor Myron, sent over from the White House.
Does he have a business card
at the Federal
yet?
Reserve. I want to get to something, TK. Check this out. Go to the dot plot and the projections. And if you go to the dot plot and you look at 2025, there is a very lonely dot at the very bottom of the screen, and it's sub 3%. Not for next year, but for this year. There is a dot there just below 3% for 2025. Now, we were all asking, and of course, when you follow those things, there are no names on the dots. You don't know who they belong to, but I think we've got a pretty good idea who this might have come from. We've been asking how aggressive Governor Myron might be. The dissent is one story. The push for a whole lot more for the year ahead.
You mean 125 basis points of rate cuts by the end of this year seems a little bit aggressive? Look, to me, that is notable, and it might be exceptional for people to hear that, and absurd if you think about the growth in the economy. And yet, how much is the market trading off this? And I wonder, how much does this have disproportionate weight in the market? Because this is someone who really is coming with the backing of the president and could be some sort of signification of who he might pick next year.
I can see this picture out the corner of my eye. So let's take this picture. And for our audience at home, I'm just going to articulate what we see on the screen right now. So you've got this lonely dot for 2025. And then in 2026, you've got this additional story to think about. This massive spread in expectations from individual policymakers at the Federal Reserve. Lisa, they have got absolutely no idea what 26 brings, what 27 brings.
Correct.
This is a low conviction Federal Reserve, and you've got to bear that in mind when you go into this news conference. These guys are not gods. They haven't got crystal balls. They are clueless going into next year.
We're all clueless. And when we were speaking today to some of the heads of retail banking, what we have seen is retailers themselves don't know how much they can pass along inflation, how much there will be this elasticity in terms of demand.
Greg Peters is not clueless. I'm looking at the Bloomberg Total Return Corporate Index, and it is a miracle price up and yield down. Do you predict that we will see these acclaimed indices, the Lehman, Barclays, et cetera, now the Bloomberg Total Return Index, they're going to break through and go through the highs of pre-COVID? I mean, we can have a new low yield regime that we just didn't think would occur.
I don't think so. I think that's heroic. I think the world has changed post-COVID. I think the environment of zero interest rates, negative interest rates will continue to be looked back on as a bad idea. That drove those rates to those levels. So
But
I don't
can
think
we go
so.
on the edge of Myron? I guess that's the question. Can we find that dot?
I don't think you can get there without a recession, honestly. And I think it's important to remember, the starting place is above neutral, right? So we're not even at the top of neutral yet.
Yeah.
So, the Fed still has room. They still can get to 4%, and they're neutral, right? And so we have a long way to go. As you get much lower, though, that's where things become really quite accommodative, and I think that's a different question. So I think we're all kind of hot and bothered by this move, but the truth of the matter is we're not in neutral territory yet.
In some ways, this was the easy decision, and every decision after this gets a little bit harder. In equities right now this afternoon, equities rolling over on the S&P 500, so negative now by about 0.25%. Check out the Russell, up by 1.24%. The rally for small caps continues. Bond yield still a little bit lower at the front end, lower at the long end. 30s are down by 3 basis points. 2s are down by almost 2 basis points.
For enterprise organizations, managing all your food needs is a tall order. But with EasyCater, you get a single workplace food vendor with the tools and resources to make it easy, giving teams across your organization an easy way to order from a huge variety of restaurants, all on one platform. All while consolidating your corporate food spend so you can control costs, streamline billing and payment, and simplify reporting. EasyCater, your business tool for food. To learn more, visit easycater.com/podcast.
Introducing the all-new Adobe Acrobat Studio, now with AI-powered PDF spaces. Do more with PDFs than you ever thought possible. Need AI to turn 100 pages of market research into 5 insights with a click? Do that with Acrobat. Need templates for a sales proposal that'll close that deal? Do that with Acrobat. Need an AI specialist to tailor the tone of your market report to sound real smart in real time? Do that with the all-new Adobe Acrobat Studio. Learn more at adobe.com/do-that-with-Acrobat.
These days, AI can help you write emails, summarize long meetings, and even create presentations that impress your most demanding customer. But how about industrial AI that uses data and simulation to boost productivity on the shop floor? AI tools that help you understand machine language. AI that helps you grow your business. With Siemens Accelerator, you can use AI services, software, and consulting from a single trusted digital business platform. Plus, you can find the right AI partner without having to search through hundreds of providers. That's AI for real, from the global market leader in industrial AI. Siemens Accelerator. Learn more at siemens.us/accelerator.
We've got Bob Michael at JP Morgan still with us. Bob, I want to come back to you. You've just heard from a Federal Reserve, and I don't know what we get in the news conference, but let's just go with what they've told us so far. They're telling us we can upgrade growth, not bring down the projections for inflation, and ultimately offer you more rate cuts. How bullish does that make you as a bond investor?
Aren't they magical? It's all dependent on their policy. If they bring rates down to where they say they're going, they think they are going to cause greater growth and maintain stable inflation. Look, I think there are so many policies in flux on the fiscal side that we don't know yet. I think what we do know is that the labor market was starting to struggle by a greater degree than we all had thought. And we saw that revision and went, and it's time to start relieving some of the pressure on corporate America now.
John, it's 2:16. We've yet to mention tariffs. I find that extraordinary.
So I'm pleased you've brought this up, TK, because I think still a lot of people are talking about the tariffs of April as an event and not a process. And I think it's far more important to be open-minded about the process and the potential of pass-through still to come. We know based on the data so far that we aren't seeing the exporters drop prices aggressively. You can see that in import prices. We know based on the data so far that a lot of companies domestically are absorbing this on margin.
Right.
What we don't know is whether they pass on those costs in the next several months and change this inflation picture entirely.
Exactly. And when I look at the Excel spreadsheet from the Fed here and the sub 2% growth, my question is, are we seeing a decline in purchasing power? And that's why you see, the curve coming down and yields coming down right now.
I think what we've seen, Tom, without a doubt, is that we've seen a massive step down in payrolls growth. That has clearly spooked some members of this Federal Reserve. But Lisa, I think it's key to point out, not all members of this Federal Reserve, that some members of this Fed will still be anchoring their labour market view around what's happening with unemployment, which has been pretty stable through all of this, through the whole of this summer. And look at the forecast from the Fed. They're still forecasting pretty stable unemployment around 4.5%.
Yeah, which is the dispersion. And going back to that is the reason why I'm struggling to interpret the move in markets right now. Because is the market taking their guidance on Myron or on the idea that there are Fed officials who are pushing back and saying, actually, we need to be tighter? Right now, is this a trial balloon for what it would be if there was a Fed that was being more aggressive? Or are we not there yet? I mean, that I think is going to be a tell in terms of, does the bond market behave if it believes that a Fed is willing to really prioritize growth in a significant way over inflation?
Hey, Bob, good to catch up as always. Bob Michael there of JP Morgan. Lisa, let's turn to Diane Swong of KPMG. She's standing by. Dan, welcome to the program. So much to process here going into this news conference in about 12 minutes' time. What's your number one issue going into the presser?
Well, first of all, it's really clear that Powell corralled the cats, and I assume that Waller and Bowman did not dissent in part because of the strong retail sales data, which also revealed inequality and something else that's going on out there, and that is that spending on restaurants went up after adjusting for inflation. Spending at grocery stores actually fell after adjusting for inflation and the retail sales numbers. And so you've got this sort of, the K-shaped economy we keep talking about, the bifurcation, but that masking the underlying weakness in lower and middle income households. So this was clearly an acknowledgement that, yes, the labor market has weakened and they want to shore up the labor market. What surprised me as well was that we had heard the Fed talk about a reduction in what they thought the neutral rate was. Powell had referred to that there had been some discussion about that in previous meetings. That did not show up in the forecast. And I think that's important as well, because they're removing restriction now. It's not just calibrating down because the neutral rate has moved down. They're trying to say, listen, we're removing some restriction, acknowledging the weakness in the labor market, want to shore up the labor market. But if you really do read this sort of through to next year with a major change in leadership at the Fed, you could have a situation where you overstimulate and get a more pernicious and self-fulfilling prophecy on the fact that consumers and firms now expect inflation to be higher. And I think what the Fed is struggling with is that consumers are also telling them in their own surveys that the job market's the worst it's been on record since 2013. That's something that has got to have startled the Fed as well.
Diane, this is without a doubt a very confusing economic time. It's also a very confusing time when it comes to the Fed's reaction function. Do you have a clear sense of how the Fed is going to prioritize incoming data, whether it's retail sales or jobless claims, or whether it's the payrolls report, and decide how much to ease?
It's really hard. This is, it's one thing for the Fed to have forecast the stagflationary, mild bout of stagflation that they did since March, that's gotten more stagflationary over time. That was hard to forecast. It's another thing to live it in real time. And that's what we're doing. And unfortunately, it is very hard to not, you have to shore up the labor market a bit. That said, right, you don't want to remove so much accommodation that you allow these waves, as we heard earlier. I mean, the idea that these are an uneven rollout of tariffs, so it's not just one and done. And Powell was careful in his Jackson Hole remarks on that too. It's not all at once. It's coming in waves. That reinforces the idea that we're going to normalize inflation, which becomes its own self-fulfilling prophecy. And the Fed really has to be quite cognizant of that.
And Diane, you own the study of Michigan, Chicago, and down south down the Mississippi River. The mail I get is people are flat on their back in this K-shaped economy. How does Jerome Powell address the have-nots of America? They don't have AI. They didn't buy NVIDIA like John 3 years ago. What do we do with the people that aren't participating in the system?
Well, it's really the inequality is getting worse. We know that. Actually, Moody's just came out with an updated estimate on some of the inequality, and the top 3.3% of households are really doing really, really well. The top 20%, a little bit better in terms of gaining spending since 21 relative to inflation. The rest of the economy, the bottom 80%, pretty much flatlining it since after adjusting for inflation on their spending patterns. That's a really tough position to be in, and it gets to the heart of what we're still dealing with is the embers of the pandemic inflation were still smoldering when you added on the tariff-induced increases in prices. And that's what's really tough for the Fed to deal with and for the average American, because remember, even when the labor market was much more robust, when inflation flared, the majority of Americans believed we were in a recession because their purchasing power was eroding and they were losing ground. And I think that's very important because it really gets to the corrosive nature of inflation. And at the end of the day, you cannot get full employment sustained unless you really derail inflation. What we don't know is if this will just be a couple steps up and then just come off, or if it will be more persistent. And that's what he's going to have to emphasize at the press conference today, is that they're going to be mindful to watch what's coming on in terms of how persistent the inflation becomes and how much inflation expectations, to get jargony, get unmoored.
NVIDIA, that's my biggest position, TK, at Hindsight Capital.
You killed it.
I wish.
You just killed it.
Diane Swank of KPMG. Diane, thank you. Appreciate it. Matt Lazzetti of Deutsche Bank standing by. Matt, welcome to the program. What an interesting forecast mix. More rate cuts in our future. Growth apparently okay. Unemployment not a problem. Explain that one, Matt.
Yes, I think for the near term, it's pretty clear. They talked about increased downside risk to the labor market, And so this is all about risk management. It's not about modal forecasts at all. As you noted, growth is stronger, the unemployment rate unchanged for this year, inflation unchanged for this year. You can see it at the back of the SCP, their forecast. There was a little bit of a shift in the distribution of risks. Those officials that are more worried about downside risk to the labor market, less officials that are more worried about upside risk to inflation. It's basically in line with what we were anticipating. The Fed shifting in a little bit more dovish direction today. Close call on the 2 versus 3 dots. I think the key question for Chair Powell is how much does he lean into the near-term signal of cutting at each meeting this year?
Do you get a sense, Matt, of how much the reaction function has shifted? John's done a really great job of talking about how from July to August, there seemed to be a shift from the unemployment rate to the headlines, payrolls report. Do you have a sense of just how tolerant this Fed is going to be of inflation well above 2% for years on end and keep cutting?
Look, I think they're showing us that they're pretty tolerant above target inflation. In fact, if you look at their forecast for next year, they actually raised their inflation forecast by 0.2. They raised their growth forecast. They lowered their unemployment rate forecast, and yet we see a lower Fed funds rate. I think the reality is we are now projecting at 5+ years of inflation being at least 50 basis points above their target, and yet they are cutting rates into that environment. So I think it's a Fed where, as long as there are no worries about the labor market, they can be hyper-focused on inflation. But once some of those concerns about the labor market really manifest, you see a pretty dovish shift. And I think that's what we saw from Chair Powell at Jackson Hole, and we're seeing it manifested now through the dot plot.
Matt Lazzotti, Diane Swonk brought it up, and many others have as well. We're all focused on tariffs and substitution. Are we seeing a decline in purchasing power here? Is there an income effect from tariffs that the Fed has to fold in? And what is this, John? 50 more beeps they're going to do by the end of the year?
Potentially, yeah. Widespread of estimates, though, TK.
Win one of them.
125.
TK, Spurs are doing all right.
Yeah, they are.
They're doing all right.
Matt, purchasing power here. This is a huge issue for Americans, isn't it?
It is, no doubt. But, I think the main area where you would first see that is through consumer spending data. And I take Diane's point and the points earlier that there's great dispersion around that data, with that being driven by higher income households. At the same time, GDP growth is tracking above 3% in Q3. It was above 3% in Q2. Retail sales are robust. CapEx growth was strong. So I think it's a Fed where, even if you are seeing it eat into disposable income growth, consumer spending growth in the aggregate is strong, and monetary policy has one blunt tool, which is the Fed funds rate. So really, they're not apt or really able to get at a lot of those distributional issues. I think Chair Powell and the Fed would probably tell you that is more up to fiscal policy, tax and spending policies that we would see from the administration. So I don't think that this is really about trying to alleviate some of those distributional concerns. I think it's concerns about the aggregate labor market, which is not being manifested in strong growth at this point in time, and them just trying to get ahead of it and taking out some insurance against that.
Matt Lazzotti, appreciate it. One of the best, Matt. Thank you, sir. Matt Lazzotti there of Deutsche Bank. The news conference a few minutes away. We often hear people come on the programme and say, I expect it to be dovish. And really the response to that should always be dovish to what? Relevant to what? Relative to who and what and where? Relative to the market, this isn't dovish. Of course, we were looking for really bullish expectations for rate cuts in the next 12 months or so. But it's their own forecasts that make this dovish. The fact that the Federal Reserve is coming out and telling you, you know what, Lisa, next year, I expect a better picture for growth. I expect a slightly higher inflation print than we did a few months ago. But you know what? I give you some rate cuts to the mix as well. That's basically what the Federal Reserve has communicated in these forecasts today.
Yeah, the currency markets are hearing that loud and clear. And I think that is the biggest tell. And I keep going back to that with the Bloomberg Dollar Spot Index now at a new post-2022 low. We have seen it completely weaken, fall versus some of its counterparts. Why? Because of this prioritization of growth over inflation by the FOMC and a reiteration of that in this SEP.
Greg, I got to ask you a basic question. You've been doing this for a few years. When you read sell-side literature right now, economic think tank literature, can you trust the forecasts?
Well, yes. I mean, I think forecasts are always fraught. The dot plot is no different than a sell-side forecast. It's not like they come with any additional information. But I think in this particular period, when there's so much going on, and I hate the word uncertainty, but it is the right word. I mean, we've been talking about tariffs as an example. We have a Supreme Court decision coming. We don't know what the shape of tariffs is going to look like after that, just as one example. So it's a really difficult environment. So you should expect to see more dispersion what the markets are trying to suss out, what I'm trying to suss out is what's real and what's political. And I think that's an open question, and time will tell on that front.
Is the political real?
Well, the political is driving the real.
They're going to be the same thing next year, aren't they?
Yeah, no, absolutely. And I think this is the world, or this is the investment realm that we have to deal with. And so it's not going to change anytime soon. But this was an incredibly dovish SEP and dot plot, and the markets are responding in kind.
We don't know for sure who that dot actually belongs to at the Federal Reserve. You can have a decent guess.
Come on.
Sure. They're not going to tell us. But here's my point.
I bet you $10.
It would be a mistake, I think, to say, that's Governor Myron, it does not matter. Isn't that a hint, a flavour of what could be coming further down the line in 2026? Isn't that ultimately what the Fed share dot could look like in the next 12 months?
This is the reason why I do believe, based on the market activity, people are putting a disproportionate amount of weight on that dot and on the view, on the dissent, because it is a flavor of who that new Fed chair could be.
We're close to Powell coming out as quick as I can. The markets will police the politicians in Washington.
TK, you say that. Look at what this Fed's just done. It's revised higher its inflation forecast and just cut rates.
But we are, as he correctly said, Greg said, we're above the neutral rate substantially. They got wiggle room here.
This decision is the easier decision. Without a doubt, we're on the same page on that front. But if anything, you could talk about this Federal Reserve falling into the hands of political actors. This Federal Reserve hasn't hit its inflation mark for years.
How many vendors does it take to meet all your organization's food needs? Just one. EasyCater, the workplace food platform that lets teams order from a huge variety of restaurants, over 100,000 nationwide, all through a single vendor. In addition to all that variety, EasyCater also gives you full visibility of your organization's food spend with invoicing, centralized reporting, and seamless integration with expense management systems, all on one platform. EasyCater, your business tool for food. To learn more, visit easycater.com/podcast. Every business starts with an idea. How can you go from daydreamer to industry leader? Amazon Business accelerates your journey. With smart business buying, get everything you need to grow in one familiar place, from office supplies to IT essentials and maintenance tools. Amazon Business takes the buying experience you know and love from Amazon, plus tools that help you save costs and make insights-based decisions. Ready to bring your visions to life? Learn how at AmazonBusiness.com. Hiscox Small Business Insurance knows there is no business like your business. Across America, over 600,000 small businesses, from accountants and architects to photographers and yoga instructors, look to Hiscox Insurance for protection. Find flexible coverage that adapts to the needs of your small business with a fast, easy online quote at Hiscox.com. That's HISCOX.com. There's no business like small business. Hiscox Small Business Insurance.